Today, we're answering newbie questions from the RealWealth community so you can get started in real estate investing today. I'm Kathy Fetke, and welcome to the RealWealth Show.
You're listening to the RealWealth Show with Kathy Fetke, the real estate investor's resource.
Today, we have a brand new format for you. I have Leah College, our investment counselor and director at RealWealth Realty, and my daughter, Krista Fetke, our social media manager at RealWealth. Welcome, both of you.
Thank you. Thanks for having us.
Good. It's fun to be here. It's little girl talk.
Now, Krista is a brand new investor. In other words, she hasn't done it yet. So she's going to be asking Leah and me some questions from our new investors.
I'm so excited to be the voice of the new investor. So today we're going to cover everything from high mortgage and interest rates to cash flow versus appreciation to which asset class will create financial freedom faster.
Well, let's jump in.
So my first newbie question is something that I think a lot of my generation is wondering. With interest rates remaining high and housing prices where they're at, how can I get into real estate as a new investor when the monthly mortgage rates and prices feel like such a hurdle?
Yeah. How do you answer that, Leah?
It's the elephant in the room, and it's on everybody's mind, not just the newbie investors. I mean, everybody is feeling the squeeze, right? And I feel like there's no easy way to sugarcoat the answer, especially when it comes to buy and hold investments. Like, people have always felt like they're expensive. And we've always wanted lower interest rates, right? We all had this little heyday where rates were extremely low, and hopefully everybody took advantage of that when they had that minor window. But really, interest rates are where they were when I started. I think my first interest rate was at 5.75, just under 6%. We're slightly higher than that today, but it's always been a big leap for new investors to get in. So my advice for someone who's feeling intimidated and overwhelmed by it is to maybe come to terms with it a little bit. And instead of disqualifying yourself right out of the gate, like it's too far, it's just too much, instead start asking yourself, how can I overcome it? And I think one of the easiest ways for new investors is to consider how they can bring their living costs, their personal living costs down, whether that's renting a room with some friends, whether that's renting a really cheap economical apartment in an affordable city, or whether that's leveraging a primary home loan and buying your first house with the smallest down payment possible and renting out the rooms to friends. I mean, any way to bring that living expense down as low as possible, I think helps jumpstart an investing journey.
100%. Krista, you probably don't remember, but I don't even know if you were born yet, so you definitely don't remember. But before your dad and I owned real estate, we rented a house, and we rented like a 4-bedroom house, and we would rent out the rooms in that house to be able to afford San Francisco. And then over time, that helped us save money to be able to buy our own house. But today, one of the best things that a first-time investor can do is buy a primary, like Leah said. You only have to put 3% down on an FHA loan. There are properties still in this country that are around $200,000. What's 3.5% of $200,000? We're talking about an amount you can save. Your sister did that, right? She got a place right out of college, and interest rates were lower, but she used that 3% loan, and over the few years that she lived there, she made about $100,000 in appreciation. So that's still an option for you, just not where you grew up. Obviously not in California.
Not in Malibu.
Yeah, not in Malibu, and probably not in Denver where you just lived. But if you were willing to be uncomfortable for a little while, then you could choose a place that's a really, really good place for investment. You could talk to Leah about where that might be. So you could choose a more affordable place just to live for a period of time. You don't have to live there forever. You don't have to live there forever on that first-time home buyer loan.
Especially for someone like you, Krista, who loves adventure and loves, experiencing new and different things. I mean, you might not have to make as many concessions as you think. You can find cute little towns. I mean, we have some teams that have really nice new construction, cute little bungalows in nice areas for, $200,000. So it is very, very possible. And here's the other thing I want to like encourage you about is that in your season of life, or when someone is new and, just getting kind of their feet under them with their careers and starting, you have a unique opportunity in that you have the potential to have the lowest living expenses ever, right? You maybe don't have a family to provide for yet. You maybe aren't as spoiled by luxuries that I feel like the older we get, the more spoiled by these luxuries we start to incorporate into our life. And so you have, I think, the gift of maybe being able to be more agile and more lean than you ever will be in your life. And so I think there's some equal upsides to being young and getting started in this that people who are older just don't have. The luxury really being time, right? Kathy, I shared this with you last week, the couple that I spoke to who, were in their 70s and trying to get an investing strategy going. And I feel way worse for that person and what the hill that they have to climb in a very short period of time in comparison to someone who's young and looking for ways to get started and has a very long runway ahead of them.
And I think that's the couple you said who they knew the power of real estate and they wanted to start 20, 30 years ago and didn't.
Right.
So the sooner you do it, the better. You both know Maggie, who has been with RealWealth since 2009. And she's kind of like you, Krista. She loves to travel. She just was able to work remotely for RealWealth for years. And, you have a remote position too. So she bought a duplex through one of our teams in Cleveland and had all her stuff in one room to keep it legal, but then rented all the rest of the rooms of one unit and then rented out the second unit and was able to travel for, I think, like 7 years, and all that time she had other people paying off her mortgage for her. Well, now she's married, has a baby, and is living. She moved into that duplex and the payment is so low. Because even though today it feels like the interest rate is high and the payment is high, trust me, in 10 years, it's going to not feel high because we live in an inflationary environment. The Fed shoots for 2% inflation, so you could be sure that the payment you pay today will probably be the lowest ever. The longer you wait, the harder it gets. So I hope that helps.
Yeah, that's really good advice from both of you. Thank you so much. I actually got an idea from that. My boyfriend and I love to travel so much that we like spending a month everywhere we go. So why not just spend a month in a new city or a few months in a new city in the United States and then travel from there and have a lower payment rather than paying $2,500 in rent in Denver while we're also on the road and paying for hotel expenses. So I love that idea. Thank you guys.
Plus, you if you're buying a $200,000 property, it's a lot easier to qualify for that on a 25-year-old income. That's a price point you could afford. It's like what your sister did. She bought a $250,000 house in Chico. And that was it was actually cheaper than her rent had been. That might be the case for you too. If you were paying $2,500 in Denver, you might be able to actually buy a place and have a lower payment.
Yeah, true. So as a new investor, should I focus on properties that have more potential for appreciation or cash flow?
Okay, this is the classic answer. It depends. What I would tell you though, I feel like there's a clear purchase that will make you more money in the long term, and that is a growth market. That's the honest answer. I think when you have appreciation, that's what I've seen in my own portfolio. And I went pretty heavy into high cash flow and diversified a little bit into growth. My hindsight, I'm like, oh, shoot, I should have done the opposite. I should have been going heavier into the growth markets. The reason I didn't is a reason why you might consider the other. And that is the cash flow markets tend to be more affordable. And so again, depending on how much capital you're working with initially and how much extra you have, like you have to have a cash flow buffer in your personal life as well to cover not just the high mortgage on that higher price property, but the incidental expenses, right? Maintenance and vacancy. And so, those cash flow homes can sometimes be an easier foot in the door for beginners. It can feel less risky because the mortgage payment is smaller. You're just dealing with smaller increments. So again, the answer is it depends on how much you can financially tolerate initially. If you make more than you spend, you have extra every month and you're accumulating savings and you've accumulated enough to afford the down payment in the growth market, go with the growth market when you're young. I mean, this is what's going to make you wealthy over time. If you can't get to that growth purchase for multiple years, I think that maybe going with the linear market is a way to get your foot in the door sooner than later.
Unless you do what I just said, which is make it a primary for a while. Let's say you buy a place in Florida, you can still get we just bought a duplex for 450,000 or so. Let's say, Leah, that there's a $300,000 or a $400,000 house. It's nice in a growth area. What's 3.5% of that? You can do that. That's a down payment you can come up with by coming home, living with mom and dad. Now, this is all in my benefit, but for a few months to save that money to be able to truly change the trajectory of your life over the coming years.
Yeah. What I found was that I was lured into the linear markets first, the cash flow markets first, because at the time I had a job that I hated. And so this idea of like financial freedom was like, that was all I could think about. And we started looking at pro formas and going, okay, we buy, 25 houses and, boom, you're done. Like, so let's just buy as many doors as we can. And over time, what we realized was that the cash flow for these, linear markets, they were in cheaper neighborhoods. They tended to attract tenants that were just a little bit tougher on the property and maybe a little more transient. So turnovers were more frequent. What I found is that my cash flow went right back into the asset. It was cannibalized by the turn or by the maintenance that was there. And so then at the end of every year, we would do a kind of a portfolio review and go, okay, well, let's look at the investment as a whole, because it's not just cash flow, right? So we go, okay, well, how much principal did the tenants pay down for us? Well, this was a dinky little loan. So it was very little principal pay down and most of it was interest. So almost nothing. How much appreciation did that asset see? And it was very, very little. Meanwhile, in the growth property that I had diversified into, the same thing happened. The cash flow was cannibalized it went right back into the asset to support it. But the difference was that growth purchase appreciated significantly more than the linear property. The principal pay down was accumulated a little bit more because it was a bigger loan. And so I started seeing that I was gaining traction over there in the growth markets, and I was just spinning my wheels in the linear markets. And so over time now, I've slowly kind of moved away from the linear purchases and sold them and focus more exclusively in the growth markets.
You might remember that we had a turnkey rental fund. We raised about $5 million and we bought houses in Florida and really high growth areas of Florida and offset that with cash flow properties in Ohio and Detroit. At the end, after 5 years, we, sold off the properties and looked at the total ROI on each area. The properties in Florida overall, when you include the appreciation, had about a 28% IRR, so annual return, basically. In the North, in the Midwest, it was about 6 to 8% return on those Detroit and Ohio properties. So just right there, if you look at the accumulation, if you held those properties for 10 years, imagine how much money you would make, in the high growth areas versus, slow growth.
That makes sense. And that's really interesting because my boyfriend Alec and I do have a chunk of money saved. And we've always said that we wanted to use it to get some cash flow to help supplement our incomes and build wealth that way. So we always kind of thought that we wanted a cash flow market. But after hearing those responses, I guess if the goal is long-term wealth building, then we'll look for appreciation.
Yep. It's the trap that so many of us, that's what lures us in. And it's true to some extent, but you have to be, I think, very realistic in the true cash flow that you see. It ebbs and flows. So you'd have 1 year where it's great. And if you already spent that money, the next year when you have your expensive turn, you're like, oh shoot, we had this big trip planned and now we got to pay $5,000 to turn our house. So yeah, it's a very common mindset that new investors have.
And also one property, the cash flow from one property is not going to help you at all.
Yeah.
It's, I look at it like you need $1 million equity. You need $1 million that you could go invest in real estate. And at the end of the day, you need to take about 6% of that, because after you pay expenses, that's kind of what you're getting. So if you want an annual income of around $60,000 a year, totally passive, you need $1 million equity to do that.
Mhm.
Just to have $10,000 to invest in your first deal, you're going to have maybe $50 a month, and I know you're going to spend that on lotion.
Yeah, definitely need to work on the minimizing my lifestyle.
It's hard. And I feel like I just heard everybody's balloon pop, Kathy. It's like the sad truth, but I think it's right to think about it one step at a time. Like most of us don't have the luxury of just having $1 million liquid to go and play with. That would be nice, right? But starting one building block at a time is how you get there.
Yeah, and that also brought up one of our biggest fears. And I think one of the reasons we've been so reluctant to get started is I've heard horror stories of people losing money on deals, picking a market. And like you were saying, like all the cash flow just goes back into the property. And then you also need to take even more out of your savings to deal with expenses and repairs and random things that come up.
Yeah.
And that's really scary when you work so hard to save up your money, just losing it and having it be a money drain. So how do you avoid something like that?
I mean, it's investing, right? It happens. I mean, I've bought some lemons before, Krista. Like it is the reality of this asset class. When you own something tangible and real and you rent it to human beings, and these homes are aging and subject to weather, like it's inevitable. Like it will cost at some point to maintain that asset. But I think that the best way to look at it is this isn't a strategy for instant gratification. Like there is some ebb and flow. And so again, that's why I kind of come back to my earlier point of like, you have to have enough of a buffer in your personal savings and your personal finance, and have discipline in your personal finances where you're not like turned upside down when those inevitabilities happen. That's the reason everybody's not doing this type of investing, because it does ask more of us. And it kind of goes back to, kind of Kathy has said this so often. It's like, there's a consciousness to this capitalism, right? It's connected to humans and it's rooted in people's lives. And so the idea that just because you have 20 grand that you should just accumulate this pile of money for no reason at all it defies human existence, right? So it's accepting that there are some setbacks and they will happen.
Yeah, and what we always tell people, Krista, is have 6 to 12 months reserve set aside. So you would not want to use your last penny to buy a property, and then suddenly your tenant loses their job and they can't make their rent and you can't make your mortgage. So you've got to have, part of the deal is that that you have put in a bank account, hopefully one that is making you some interest on it, that you've put 6 months to 12 months reserves. If you put 12 months reserves, and I know you are very conservative financially, you don't want stress, so I would put 12 months reserves aside. What that means is if the rent you're getting on that property is $1,000 a month, you'd want $12,000 in the bank. That's a little extreme. A lot of people will do the 6 months. So $6,000 should do it. But if you just don't want those worries, that's how you get around it.
Okay, that makes sense. I definitely prefer the stress-free option, so I'd like to have more of a buffer.
Yeah. You want to sleep good at night. I'm similar, Kathy. I like to err on the side of too much and sleep well than be stressed out about finance. But Krista, I go back to one of the benefits of being young in this is you're in prime working years. Like you have more energy than you'll ever have. And so in the event that you started feeling like some financial squeeze, the ability to pick up an extra shift or pick up a side hustle, you are in the prime age to figure it out when there are some challenges, if there are some challenges.
That's very true. Something Alec and I have learned is anytime we want to make a big expense or have a fancy dinner or treat ourselves to something that we know is a little bit outside of our budget, Alec just signed up for Uber. And if he's like, I really want to go to this concert, it's $300, but I really want to go, he'll just do 2 days on a weekend of driving Uber and then makes up for that. So we do have the time to kind of put in a little bit of extra work and just make some money on the side at this time. So what will get me to retirement faster, investing in single family or multifamily?
That's a good question. It depends on the multifamily, I would say. Like if you're talking about a duplex or a fourplex, that's still, you still can get a fixed rate mortgage on that. It's still conventional financing. If you go over 5 units, then you're in commercial financing, and it's kind of a whole different animal. Obviously, people would love to own apartments, right? But there's going to be a lot more to that. Those are adjustable rate mortgages. You've got lots of units to manage, and there's going to be a really big down payment. Generally, when I first started, some of my mentors taught me that a single family is going to appreciate faster. And that's simply because there's more people who will want to buy that than maybe buy your duplex from you or your fourplex someday in the future. That hasn't always been the truth. And I know Leah bought some quadplexes that have appreciated really well, right? So what are your thoughts, Leah? Do you think there's really a difference?
I mean, there's pros and cons. I hate to give the it depends answer again, but I think Kathy said the word depends first, so I'll follow. I'll follow your lead. I mean, there's some cons to multifamily. It's a less liquid asset class, generally speaking. Typically, the buyer of a multifamily is another investor. And what do investors care about? They care about returns, right? And what impacts returns? External factors like interest rates and what the economy is doing, right? And so you can find yourself in a scenario where maybe you have a personal reason to exit or sell the property, right? But it doesn't align with the right timing to sell a multifamily. Investors maybe won't pay the price that you need to exit the property. So I think you have to go into a multifamily knowing that it's just a different exit strategy. It's a slower exit strategy. I mean, there are more people today, arguably, that are choosing to house hack in a multifamily and wanting to rent, one side of it and live in the other. So maybe there's more buyers than there used to be. But that's why I've always kind of preferred single family. And I think why Kathy mentioned, that, the single families tend to appreciate more because there's just more consumers for them. So there's more driving home values up for single family. So I personally favor the single family, even though I've had some amazing multifamily purchases that were dumb luck, frankly. I am partial to the single family. I think they're easier to get in and out of.
Okay, that makes sense. This might be a it depends answer as well, but let's say you were coming into money or had like a chunk of inheritance coming or something. What asset class do you think would be like the best? I know this is a loaded question, but like between syndications, multifamily, commercial, single family, like there's so many options out there. If you just had a chunk of money coming your way, what do you think is the best strategy to build wealth fast, I guess, or the most wealth? I don't know.
Yeah, you're looking at a totally different ballgame when you have money. And I'm glad you asked that, Krista, because there's going to be a lot of people inheriting money, and a lot of money. And if they don't play their cards right, if they haven't been educated, they could lose it. I actually had a friend who inherited money from her mother who passed away, and she didn't do very well with her investments. And she was heartbroken because she felt like she had let her mother down, even though she had already passed on. That was what was left for her, and she wanted to do better. She ended up becoming a good real estate investor as a result of it. But there is tremendous responsibility when people inherit money, but then maybe don't know what to do with it. So in answer to your question, the thing you should do is the thing that you understand. So if you could make money in any of the things that you just said. I think you're going to make more money in real estate because you're young and you can leverage. So let's say you inherit $1 million. That would buy you $4 million. I'm throwing numbers out there, but $4 million worth of property that over time, if that just appreciates it, let's just say 3%. You're making a lot of money every year versus if you took that $1 million and you bought $1 million worth of stock, made 6% on that, you're only making your return on that amount. You can't really leverage it. I mean, you can, but it's riskier. So to me, hands down, putting a lot of it, you should diversify, but putting a lot of it in leveraged real estate will make you even more wealthy in, over the years.
I think you nailed it. I mean, I think that what I would personally try to avoid, and this depends obviously how much you're inheriting. I mean, if you're inheriting a ton of money, obviously there's less urgency to reinvest it like immediately, right? But I think I would avoid the desire to like invest it at once, and give yourself some space. Again, if you have the luxury to have some space to learn your strategy and kind of develop some of your preferences. This is why, again, it's easier, especially for the millennial generation who's about to inherit all this money. Like if you've started the strategy now, maybe it's slow of buying properties, you're learning how to handle that money. Then when you do come into the windfall or the inheritance, you already kind of know, your successes, and people probably that can help you scale in a market. So, that would be a tremendous luxury to be able to do it slowly. But that would be my biggest thing is when I have people who come in with, big 1031 exchanges, well, 1031 exchange is different, but when I've had people come in with big inheritances, I usually try to pump the brakes a little bit and say okay, wait, let's do one at a time, or a small little handful of properties at a time. We don't need to rush and, jump into something that's totally new in 10 different markets. That could be the wrong choice.
Yeah, that's really great advice. Thank you. Thank you both.
Well, we are running out of time, but we have so many more questions that, we'd love to go over. We might just have to do this again, do a second show. But Krista, do you have any final burning questions you'd like to ask before we wrap up?
Yeah, I guess my final question is, where do I start? What's the first real wealth investment that I should purchase?
Call me, Krista. I know some people.
Will do. We need a strategy session.
Yeah. And for those of you who don't know, we have 3 investment counselors at RealWealth who are very experienced. They've bought with many of the teams that we recommend that have property management in place at RealWealth. So you can join for free and speak with one of our investment counselors to get their insight on what investors are saying about different markets, different teams, where they're having the best results, and get some insider information that's legal. All right. Well, Krista, thank you for being here. Leah, thank you as always for bringing your insights and wisdom to the Real Wealth Show and to our Real Wealth members. And thank you, our listeners, for joining us here on the Real Wealth Show. You can get more information at realwealthshow.com, where we have over 500 free webinars on asset protection, where you get investor loans, all kinds of good things, tax benefits. You can get that information for free at realwealthshow.com. And thank you, our listeners, for joining us here on the Real Wealth Show. You can get more information at realwealthshow.com, where we have over 500 free webinars on asset protection, where you get investor loans, all kinds of good things, tax benefits. You can get that information for free at realwealthshow.com.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.